Welcome back to Curious Commerce. Topic Cash Flow Statement, Part 7. Today we will discuss about working capital changes, operational activity, and the investment activity. In the indirect method, after adjusting net profit for non cash and non operating items, the next step is to adjust for working capital changes. Working capital means we already know that working capital equals to current asset minus current liability, or the difference between the current asset and current liability we called as in the working capital. These items directly affect cash available for daily business operations. First, we should understand the logic behind that. Did cash get used or did cash come into business? Automatically, working capital changes. Let us where cash moved. The second step, the current asset adjustment. The current assets include debtors, what we call as an account receivable, inventory or stock, bills receivable, prepaid expenses, and the short-term assets. Increase in current assets leads to cash decreases. For example, debtors increased from 50,000 to 80,000 rupees. This means more goods sold or credit, or money not yet received, or cash stuck with customers. So, cash decreases. Hence, we subtract increase in current assets. For example, you sold goods but have not collected cash yet. That is the situation. The second scenario is decrease in current assets leads to cash increases. For example, debtors reduced from 80,000 rupees to 50,000 rupees. This means customers paid cash. Cash came into business, so cash increases. Hence, we add decrease in current assets. Step third is current liability adjustments. Current liability include creditors, bills payable, outstanding expenses, and short-term payables. In case increase in current liabilities leads to cash increases. For example, creditor increased from 40,000 rupees to 70,000 rupees. It shows purchase made on credit, or payment not yet made, or cash saved for now. So cash increases. Hence, we add increase in current liability. The last scenario is decrease in current liabilities leads to cash decreases. For example, creditors reduced from 70,000 rupees to 40,000 rupees. This means business paid suppliers or cash went out. So cash decreases. Hence, we subtract decrease in current liabilities. Imagine your home finances. If friends owe your money, cash not in hand, right? You owe money to shopkeepers, you still have cash. So, money struck outside reduces cash. Payment delayed increases cash. Business works the same way. Remember the simple rule: asset increases, cash decreases. Cash decreases, asset increases. Vice versa. When the asset decreases, cash increases. The third scenario is liability increases, cash increases. Liability decreases, cash decreases. So we should concentrate on each current assets and the current liabilities for the adjustment activities. Working capital adjustment shows where cash is blocked, where cash is saved, and actual operating cash available. Investing activities show how a business uses cash to buy or sell long term assets and investments. These activities indicate the future growth plan of the business. In simple words, investing activities show where company invests money for future benefits. But the basic question is why are they important? Investing activities tell us, is the company expanding? Is it selling assets? Is it investing for future profits? For example, buying machinery means that's the expansion activity, right? Selling land may mean raising cash. So investors understand company growth strategy through this section. Certain examples related to the investment activities. Let us understand common examples. The purchase of machinery. When a company buys machines or equipment, cash goes out. For example, machine purchased for rupees 3 lakh, it leads to cash decreases. This is the cash outflow. The second example is sale of land or building or sale of asset. If a company sells land or building or any asset, cash comes in. For example, land sold for rupees 5 lakh leads to cash increases. This is a cash inflow. The third general example is purchase of long-term investment. If a company buys shares, bonds, or investment for long-term holding, cash is used. For example, investment purchased for rupees 2 lakh leads to cash decreases. The fourth one is sale of investment. If investments are sold, cash comes into business. For example, investment sold for rupees 1,50,000 leads to cash increases. Investing activities deals only with long-term asset, not daily operations. Examples of long-term assets are machinery, land and building, equipment, long-term investment, and vehicles used in business. Let us see a practical case, a company transactions. Purchase of machinery for rupees 3 lakh, old equipment sold for 1 lakh. Net cash used in investing is 2 lakh. It is very simple. The difference between the 3 lakh and 1 lakh. 3 lakh and 1 lakh is 2 lakh rupees is the net cash used in investment. Now we should analyze about this transaction step by step. Purchase of machinery for 3 lakh rupees is the cash outflow, right? So the equipment sale, the old equipment sold, it is for 1 lakh rupees. It means that the cash inflow, is it right? The 1 lakh rupees is the cash inflow. So net investing cash flow is 1 lakh minus 3 lakh is minus 2 lakh rupees. Negative sign means cash used in investing activities. This is the negative. This is the negative 2 lakh rupees. Interpretation of this example. Company invested more money in asset than it received. Business may be expanding or upgrading equipment. So cash is used today for future benefit. Easy logic to remember: buying asset leads to cash goes out. Selling asset leads to cash comes in. Investing activities help us understand company expansion, asset purchase or sale, or long term investing decisions. Thank you all. Please subscribe, share, and like to Curious Commerce. Follow our WhatsApp channel, Curious Commerce Financial Management Hub, for daily finance learning. The topic: cash flow statement, continue in part 8.